3, 2, 1.
This is The Jungle, an up-close, unvarnished look inside leadership and business strategy. We wade into the real-world leaders' face and explore what they do to create a path forward, because that's what business is. Wild, exciting.
It's The Jungle.
Derek, we're back in the jungle again.
We are, Doug.
And we're going to be continuing our theme here on finance, investment, acquiring businesses, private capital. We had a great guest on the podcast. We had Jeb Burns. Good old Jeb. Jeb is the Chief Investment Officer of the Municipal Employees Retirement System of Michigan, also known as MERS. We got to know Jeb, I think last summer.
Yep.
Maybe?
Last summer, first meeting, and then there's some COVID stuff. But yeah, Jeb's been a good friend to this point.
Yeah, and we had a great chance to catch up, Jeb and I, at Homecoming. Shout out to Jeb and Trustee Trevan, who for hosting us. We had a nice time a while back at the
Not
the
we,
Homecoming
you did.
True.
I
did.
didn't
You
get the
had
invite.
kids sports probably.
I
or
had kids
something.
sports.
Yeah.
I didn't get the invite either. Oh, I think I didn't get the invite. So I'm going to call out Trevan and Jeb next time.
Jeb is
I'm way more fun than you at a football game.
Probably. And Jeb is. I mean, we had a great conversation. It was fun, but you should see him when he's at a homecoming football game. He's even funnier.
Yeah.
Great sense of humor. But Jeb has been a great help, really, in all sincerity, a great help to us, and good advice, good connections, and a great Bronco. So.
Western alum, and has a really important job managing the retirement fund, the MERS. There's a lot of investment decisions he has to make day in and day out around how they deploy that capital.
Yeah,
and it's a big pool of capital.
It's a very big pool of capital. So what was your takeaway?
Yeah, so I like some of just Jeb's overall takeaways on how chief investment officers think, how they work with their teams. They have a private capital team, they have the public markets team. He had some really good takeaways on making sure you have enough liquidity for the retirement system. You can't go beyond that. Some of the assets they're buying, that some of these big, we're seeing some of that. A lot of the music albums being sold early this year. I keep seeing those pop up in the news feeds of private equity buying music labels.
You're so old that a Springsteen kind of thing, right?
There were some older ones too. Yeah, I don't need the old jokes. But yeah, the Springsteen book was sold. I thought David Bowie sold, a few others. Jeb was talking about his favorite, Justin Bieber, right? He's a huge Justin Bieber fan.
Yes, exactly.
So he was super excited about that book. He was all in.
Yeah.
It's on his playlist every day.
The Biebs, yeah. I can see him getting into that kind of thing.
That's his workout playlist, I think. No, but in all sincerity, he was great. What I did like about how he looked at the investments he makes. They make a lot of direct investments, but also he said some, I'm going to selfishly plug first-time funds, which we are, some good comments about, first-time fund managers, they're still hungry, they have to work hard, they can't rely on past success and walk in and say past success. They a lot of their wealth is still tied up in that fund, and the economics are in the investor's favor when you got a first-time fund manager that really has to get after it and really has to be successful. And the data shows that first-time funds are actually super successful, although most people just discount them for that reason with no thought.
Yeah.
Right? It's easy to say, oh, you're a first-time fund, I'm going to say no, when a lot of first-time funds outperform most of the funds.
Yep. Yeah, that is
on average. There's the really experts in this space that do well year in and year out, but first-time funds do really well.
It's a question we get, right, and we always point to that pitch book data, which is first-time funds do perform better, and he gave a great reason for that.
We'll say that until our second fund, and then we'll say second-time funds are better performers.
Yeah. Well, I mean, so speaking of first-time funds, what I loved is his advice for young people to take chances, and the importance of taking chances for him. I mean, he's a history major. We talked a little bit about that. He's a history major from Western. Now he's a chief investment officer with billions and billions of dollars that he is ultimately accountable for, and people's pensions, which he's accountable for, and just the importance of being entrepreneurial and going out there and trying something new. That's something that we're we do on a day-to-day basis. But it's great for young people because there's the set path that maybe you're told in school, your parents tell you you've got to do this, you've got to do that, but taking those chances and being comfortable to take a risk, which can be uncomfortable, particularly for undergrads. That was, I thought, great advice for everybody. So.
Yeah, it doesn't happen often. You got to know when it's there, and being uncomfortable and willing to take that big risk is a lot of things that a lot of people won't do, and he did it, and he's made a great, he's in a great job, great role, great success in life. So, and a big Bieber fan, Jeb.
Yeah. Well, I'm glad, it was a great podcast. I'm glad we could have him down. He had a chance to connect with some of our students here at Sleeping Giant, which was great.
He gave them great advice. It was really cool to have him in our space and have him around.
I'm really glad he didn't go where he told me he was going to go with the podcast, which I think would have gone viral. Maybe we should have done that. But a lot of requests. I've gotten some requests to get this episode out because people are excited to hear from Jeb. So we hope everybody enjoys the conversation with Jeb Burns.
The Jungle is produced by the Center for Principled Leadership and Business Strategy in Western Michigan University's Hayworth College of Business. Our center supports the leadership and business strategy major, conducts large-scale consulting projects, and trains professionals in acquiring and operating small businesses. To learn more, visit wmich.edu/leadership.
3, 2, 1. Jeb Burns. Cheers. Welcome to the podcast.
Cheers.
Welcome to the podcast, Jeb.
So
We're
here in our new space. We are actually set up here with some legit podcast equipment. You're the first guest, Jeb, to experience the new setup. Cameras, mics, booms. How do you feel? Downtown. How do you feel about this?
It's Class A for sure. I mean, this is New York. I mean, it is.
It is.
Yeah, for sure.
It is. I mean,
Jeb saw the space today too, Doug.
it is.
Downtown space. What do you think about it, Jeb?
It's collaborative. Pretty nice.
Now, how did you feel, Jeb, about maybe making a photobomb into our Christmas card picture? How'd you feel about that?
Well, I was pretty excited to be a part of it. It was your typical family, Christmas picture type situation.
Yeah.
We were, the matriarchs in the middle.
Mm-hmm.
Because we're, exposing to all, bringing everybody in.
Yeah.
And, it was nice. It was good to be part of it.
So, everybody probably already knows the famous Jeb Burns, but for listeners who don't know who you are, how would you introduce yourself in your current role that you do as a fund manager? Is that how you would describe yourself? A grand poobah, as a visionary? How would you describe it?
Well, I think the first way I would describe myself is that of a loyal Bronco.
That's good.
No question about that. So, came out of Western. Western was good to me, and so I try to do everything I can to kind of help the school since then. But maybe international financier, I might go with that.
Okay.
But
That's close to Grand Poobah.
Yeah.
International financier is
that-
close to Grand Poobah.
that is. But what's interesting is, people, when you control a bunch of money, people think you're pretty funny.
Yeah.
And they think you're very, very attractive and that kind of thing. But I think actually what you call me is I'm an institutional fund manager. That's what I am. I work for Mercer, Michigan. We're a statewide pension fund. We're a public nonprofit, so we manage assets for defined contribution, defined benefit, healthcare programs for probably about over 900 municipalities in the state, and we manage over $15 billion. So my job is to take that capital with my team and with external managers and put it to work. So.
And what for somebody who's maybe not versed in this world of what you do, how would you describe it? Like, what's a day in the life for you?
Well, we talked earlier. The first thing I get up is I have my mandatory 3 cups of coffee. It's Diet Coke does not count.
Yeah.
It doesn't count. So, but I think a day in the life is you get up and you do research. So it's like what's going on in the market. And really, it's more not so much what's happening today, because we're long-term investors. But you just find out, so what are the trends, or what's supporting trends that you're looking at. But it's, a lot of times it's talking to your peers, it's collaborating with your team, It's idea generation. So, investment management is not just numbers. We were talking before we got on the call. It's about, what are the themes which are going to be long term that are going to support, like what's a tailwind to make an investment.
Yep.
And so a lot of time I'll be researching that. We subscribe to numerous services. They're paid research, geopolitical, macroeconomic, and then, and on the micro side. And I will read those stories, and and then try to pay attention. What's changed a little bit now is my background was, I studied history and political science here at Western, and that's kind of what I like. But geopolitics is more important now than it ever has been, because as we've moved from, as globalization has peaked and it's frankly retreating, we're moving into a more mercantilist, world. Multipolarity is kind of becoming the norm. You're seeing in all countries, not just, for instance, China, but you're seeing nationalist economic policies being really more explicit. And so that what does that mean? That means there's going to be more regulation. It also means, there's going to be opportunities, and there's also going to be risks. So before, where it was just how much leverage are you going to put on an investment, right? Or how good is the company? Now you really do need to think about, what is the impact of the governments where your investments are domiciled. So I spend a lot of time thinking about that and researching that, because at the end of the day, as a CIO, my job is to set strategy. And then my team, they're going to be more on the ground involved in individual investments.
So
Before we go any further,
Okay.
take us from history, studying history at Western, to how do you become a manager of one of the biggest funds in Michigan, I'm assuming. Got to be up there.
And don't tell us the whole history of all the stories you've already told me about your time at Western, maybe, but those can stay private. Just
right.
The history, measured into managing all this money and doing what you do.
Yeah, it maybe not the largest in the state, but probably the most innovative, and interesting.
That's
interesting. And it's but because it comes down to leadership, as you guys know.
Yeah.
But I think that the story starts. It's not that long. I went to school and I studied what I loved. It was that simple. I went to school to get an education. My intent was always to go into business of some kind. We don't want to get a long winding road, but the short answer is I had a brief stint as a stockbroker outside of work, and that was that was sales. Making phone calls. Not really my cup of tea, being more of a strategic person. And then I went back to grad school, and my plan was to go into government for a while and then come out, again, go back into the private sector. And really what it was about was setting a vision. It's like, what did I want to do? And I wanted a job that provided me, that was very difficult, where I work with really, really smart people, where, big issues kind of had to be dealt with. And so I started my research, and I started getting experience, and then an opportunity presented itself to run a fund where I had worked had spun out of the state government, and they needed to kind of build a team. And I think it's because I had the right personality that I was comfortable doing that. A lot of people aren't. People say they are. I mean, you guys are entrepreneurs. You understand how this is. Some people, they're great if you bring them in to take over a business which is already set up. Not everybody's wired to build it as they go. And I was telling the kids beforehand, once or twice in your career, you have an opportunity. You look for that opportunity. And I found myself in a room interviewing, and I'm like, I've never done this before, but I'm pretty sure that I can. And they took a chance on me. And 20 years later, I've built, I think, one of the best institutional teams in the country, and I built it, by supplementing, I'm not a numbers guy. So what do? My team's made up of, numbers rock stars.
Yeah.
That's what it's about. It's about putting together the pieces you need to be successful.
So what do you think about the tension or the conflicting advice you get to sometimes young people, even professionals, where it's specialization versus being a generalist. Having, a very specific, super detailed focus versus getting exposure to some of these different things and having maybe a more eclectic take on something. Is the world more geared towards the specialist to the generalist? How do you see that?
I think currently, to our detriment, it's to the specialist, and this really comes out of this is the post World War II era, and I'll try not to be too political because I know that just makes everybody get angry. But if you look at the approach to COVID, just as an example, there's been a focus sometimes obsessively on the science and not on the practical realities of people. People aren't widgets. People are people. They're emotional. They have needs. It's just, and common sense really comes from being a generalist, because you can see you can see the consequences of your actions. There's what I always try to tell particularly the younger people on my team is, there's the perfect answer, and then there's the answer that we practically can do. There are political considerations in everybody's job, and if you ignore the human element, you ignore it to your detriment. So, and I think that also in a leadership role, even if you're a specialist, right, and you're running a group, if you're in a medical field, the specialist is going to have more of a generalist view. I should say the leader of that group is going to have to look more broadly. So I think it's important, and I think in investments having a broader view is important because you have to be nimble.
Yeah.
And there's also a tendency, I think, if you're a specialist, to hold on longer than you should. You can't pivot. If an investment's going down, you got to get out.
So let's talk about your world now, which is the investment. Give us there's a lot of stuff going on that maybe listeners are thinking about. They're personally investing money, they're running a business, they're figuring out where they want to make their bets. Give us your high level take of what you're seeing in the landscape right now.
First off is individuals, and this is for everybody around the state right now. The best thing to do is invest for the long run with a diversified portfolio. Now, how you diversify it, that's different. How much risk you're willing to take, but I still think that that's the best way to do it. You put money away, and you consistently put money away. Markets are going to move up and down. But the one thing we know is, if you look out over 100 years, the trend line's up. Markets generally go up over time.
So you're telling me I shouldn't take all that money and be buying NFTs right now and some crazy artwork, or not?
That's part of diversification.
Okay.
It's a diversification.
Okay.
A small part.
I hear sometimes from some people that if I get this picture of a pixelated monkey or something and I put it on my phone, that all of a sudden I'm going to be a millionaire.
I fully don't get that.
Okay.
I just I've seen the picture. It doesn't look that cool. I don't know why it's worth $2 million. I just don't. I don't get it. But I think the same goes for us. You're managing risk to a certain degree. You want to grow your portfolio. If it's a personal portfolio, Sleeping Giants portfolio, or my portfolio, you want to grow it over time. So you need to have some kind of diversification, because you also know that you're going to have shocks to the system. It's guaranteed, right? Which means it's going to be a time to deploy capital. So you got to make sure you've got some capital put to work. But I think the way I'm looking at the world right now. So first off, I know, and I think I've learned this the hard way, is growth is going to happen. So markets generally are going to go up. So making sure you're taking the right amount of risk, not too little risk, I think is important. And frankly, you need to take risk. Even if you're retiring, you could retire at 65. You could live 20 years. It's probably going to happen. You better not be in bonds. But the thing that I'm looking at is we find ourselves right now. The world's changed. Now, people aren't different, contrary to what everybody says. They're good, they're bad, they do whatever they're going to do. They're emotional, dramatic. I'm not that guy, but some people are.
Yes, Doug's that guy.
Yeah.
Oh, is it? Okay.
Yeah, I'm not that guy.
Yeah.
I'm like, yes, anybody that knows me, just zen, like water, just flows over me.
Yeah, I can see that.
Yeah.
Stoic.
Yeah, totally.
Stoic.
Yeah, and I never rant about anything. And the other thing is, they don't go off on tangents. you know? So if I'm running a meeting, it's always right on time.
Yeah.
Anyways, you asked me a question.
No, you were saying that
New investing world.
you were
Yeah.
saying and that the world has fundamentally changed.
Yes.
People have not changed. The world has changed. What is the Jeb Burns thesis on
Yeah.
what's changed?
So, you know, I'm gonna go back political for a second, then I'll get right to where we are today. And, you know, the Bretton Woods world that was created after World War II and our kind of, you know, defense umbrella that we used to, you know, end the Cold War. But you put up all these international structures to support that, but it doesn't matter to us anymore. So and we've all known this. It's kind of like we've known that things have changed, you know, for the last 20 years. But, you know, this is where the last president, I won't mention his name because people have a heart attack. But you know, whoever came in, nothing. You know, we weren't going to keep funding. You know, NATO didn't matter anymore as much as it did. I mean, all these things have uses, but we have other things we need to do with our money. It's that simple. We don't need to put it all into that one area anymore. And, you know, we're not going to pay for protecting everybody else's trade. That's just a reality of what's happening. So that's one thing that's, you know, so they're like the world, you know, the U.S. isn't the world's policeman anymore. Well, no, we're not, because we don't care. Now, we care at one level, but we don't care like we used to because it's not as much in our interest. So that's changed a little bit. So what that means is where markets were completely open before, they're now closing. So now you have to, your country selection, and like I said earlier, your attention to what's the regulatory framework in places you invest. That's more important than it used to be, because people aren't simply going to do what's in our interests. You know, before, you know, you're sending a lot of money to these countries, or you are their defense umbrella. At the end of the day, they're going to pretty much do what you want. Today, not so much. So trade policy matters more than it ever has. The other thing so that's kind of been happening for 20 years, and people are finally realizing, you know, and when you read any of the, you know, geopolitical or macroeconomic research, they're all it's finally been acknowledged that you know, it's not 1990 anymore.
Yeah.
But then the other thing is the way we work has changed. It's like we're never going back to the way we used to. You know,
The way we used to work.
what it means to work. We had a structure that came out of where the Industrial Revolution was very hierarchical. Now, in investments, in pockets of investments, particularly on the private side and not, you know, on the, you know, venture side, things have been flattening out for a long time. I had a lot of flexibility in my work. I traveled. I had a phone. I had a laptop. I mean, I would work from vacations. Not that I should have, but I worked a lot all over the world. You know, I work in a conference room. I work in a chair. I work in my car. But yet there was always this little guilt, like, oh no, I need to get back in the office, right? Well, now we've had almost 2 years of this. And what we found was the technology that we didn't pay that much attention to is there. We can do the work. We find we're actually more efficient getting our work done, right? So doing the writing or doing the hardcore research, collaborations are more different. But you can work at home. So what does that mean to real estate? What does that mean to teams? What does that mean to careers? I mean, all this is in flux right now, and I just don't think, how can you go back now and tell people, it's like, you gotta be in the office from 8 to 5, especially if you're a knowledge worker. I mean, like, nobody in the room is gonna agree that is necessary.
So when you take your investment, or you're taking a strategy view on an investment, do you typically start kind of politics as your first opening move? I mean, one thing we talk a lot about in what we're doing at Sleeping Giant and in LBS is, you know, people come at these strategy questions from different lenses, right? The CFO is starting with one assumption and they kind of build up from there. The you know, CMO starts someplace else. Do you start with kind of politics as a kind of as a shaping lens, and then kind of look at the implications off that?
Yeah, that's my natural bias. You know, that's, you know, probably, you know, macroeconomic politics. That's kind of the lens I look for. And the other thing I'm looking for is trends. So it's part of it's my bias from what I studied, and just what I like. But then I'm looking for what are the cyclical trends that are gonna, matter. I give just one example. And it's not like I'm the smartest guy in the world. We all understood this. Shopping was moving online, even before the pandemic. The pandemic is just an accelerator to a lot of things. But I had a fund 4 or 5 years ago in my office, and they were a global fund, invested in malls. So this is 5 years ago. And I looked at the trend, I'm like, I don't, they're pitching me, and I'm just like, no. I'm not, I don't see a future in that. That's probably even more important. The geopolitics that's risk. That you put that into your risk equation. So I'm not going to get paid because I think there's so much risk there. But the other thing is there a sustainable trend is a tailwind to an investment. It basically helps you if you make mistakes, and it juices up your returns at the end because you're not having to work it out. The market's kind of carrying you. And
now we were talking a little bit before we started recording about some music folks that approached you. Now you're talking about malls, and earlier in the conversation you were talking about national policy in other countries, right? So give us a sense of what is the diversity of the investment opportunities that you're looking at, so people get a sense for the kind of breadth that you need to have to be successful at what you do.
Yeah, so give you just like rough numbers. So I'll try to keep it to 100%, and so about 22% right now is privates. So that's like what you do, right? Private equity funds, real assets. It might be farmland. We own, we own farm and grazing land in Australia. We own avocados and blueberries in Peru. We own a coffee plantation in Hawaii. That's the real asset side. We own, real estate funds that invest globally. We have co-investments, of real estate around the country. That's the private side. There's infrastructure in there as well. And then the rest is a mixture of stocks and bonds. We've got about as low amount of stocks as we can because rates are so low. And then those are invested globally. So emerging market, small cap. You have international stocks, domestic, up the cap spectrum. And so you really you're involved in everything.
Yeah.
And the thing is, on the private side, you see it more directly because it's like if you invest in an index, it's got companies that are involved in everything. But on the private side, you're close because you're actually investing directly into companies.
So early December here, 2021, so I'll date stamp this. It seems, you read the news, lots of things happening, lots of risk from trends, from COVID coming back, going away. It also seems a lot of things have really, really, really high valuations on them. Whether it's stocks seem to be way up, although some this week, some went back down quickly. Venture capital seems to be steaming along, doing great returns. How do you, when you see crypto, Bitcoin, all that's high, at least from relative recent past, how do you look at those type of trends in the long term? Or is this just a bump, or is it they're going to keep going up, or do you try and be a little more active when you see, there's a lot of high prices right now?
There are, and I think that one of the factors of that is, look at where interest rates are. So we have thank God, we have no investment grade bonds. And we've got some treasuries, and then we've got, I think maybe 16% fixed income that would be like safe. Because you're forced to invest in equities, you're forced to invest in other assets because you can't make any money. Our bogey's 7.35. Think about it. Even if you have a 6% return assumption that you need to make to, for your endowment or foundation, you can't do that in bonds, right? So part of that props up the market. Also, you have more institutional capital coming in. Think about this. Emerging markets have emerged. You've got sovereign wealth funds all around the globe. You've got insurance companies all on the globe starting. All these people are doing the same things that we're doing. So that props up the market. And and with rates low, now the global financial crisis, so did take some systemic risk out of the system, and so our market's too high. They're fully valued. Some are too high, but does it mean it can't go on for another 10 years? No, I don't think it does. I think you're going to have growth, and I think valuations are going to stay high. Now the question is, are you going to see the same kind of growth with valuations this high? Could you kind of almost flatline for a while? I think that's a possibility. But I've been wrong for quite a while, thinking that things were too overvalued.
All right, Jeb, so let's go to your macroeconomic view. One of the big things is inflation right now. Is it transitory? Is it here for good? Is it, is it going to stop? Does it keep going? How do you take something like that, supply chain bottlenecks all over the world, and some of the trends is that the reshoring of some of that stuff, how do you take something like that from a macro view? If you're the macro person, how do you take something like that could create, break all the models we previously built?
Well, models work until they don't. That's pretty much, they're just a guidepost, right?
The day after you invest the model, right?
Yeah. The one thing I know is whatever I estimate, the final number will not be that. That's guaranteed. I think because we overlay everything with a valuation-based asset allocation approach. So we value like 9 different segments, and we track them. And then we over and underweight the portfolio based on that. So obviously we're underweight the U.S. Because the valuations are high versus other markets. That worked in the beginning of the year. It's not working, right now. But we had put into our long-term model that inflation was going to go up. So before this happened, it seemed like with this much stimulus that's been going for a long time, it just simply only makes sense that you would see greater inflation. Also, if you look at demographics, which is another area I spend a lot of time on, so you think about, the boomers, they're leaving the workforce. They're followed by a much smaller generation, the X generation. I'm kind of the very high end of that, and and then the millennials, which is a really large generation. So you're going to have labor is going to become more dear, and this happened globally because you're seeing the aging of, many places, going to replacement rates. So that's going to push up labor costs, and we've seen it right now. And then it's somewhat mysterious what's happened to all the people that used to work, because costs are going up everywhere, and you can't find workers, I spent a lot of time in northern Michigan, and it's like, it was never a problem. You can't find people in restaurants. You can't find people who work for ferry services. You can't find people who work in stores. So all those things are inflationary. And then I think the supply chain issues. You've had almost a perfect storm. So you had the pandemic. So everybody cancels orders of raw materials, right? And then they were wrong because things came back a lot quicker than everybody's thought. At the same time, everyone starts ordering. So then supply is diminished. So now everything is going up at the same time, and then people can't get it to where it needs to go. So that's definitely inflationary for right now. We're seeing it. I think this year it's between 6.5 or something for the trailing 12 months. That's a lot different than 1.9. And so I think that we're going to have a permanent increase in inflation for probably the next decade. I think that's just going to happen. Now this spike, I'm leaning more towards that once the supply chain issues get worked out, which is probably 12 to 18 months, that you'll see a dip. Because, how many cars can you buy? How many times can you renovate your house? So I think, and labor will kind of settle out a little bit, but that's kind of my view. I don't see hyperinflation like in the 70s. I'll show all of them. I didn't work at that time, but I would literally remember driving by and the bank had a sign, and the sign was for a 14% CD. you know.
You pulled in, right?
Yeah, well, I was in the backseat of the car. I didn't have a driver's license at the time, but I don't really see that. Well, and the Fed just, you know, this week, they're gonna start raising rates. So they were pretty explicit that they're gonna do it. They're not gonna pull back because you have to. You can't, you know. Now, part of the thing is inflation kind of solves the pensions problems.
Yeah, yeah.
Retirees don't like it, but you know, because the worth of your money goes down. So that's kind of how I see that. But from a portfolio position, because you know we expected higher inflation, not maybe the 6-7%. I feel pretty good. We've had a lot of agriculture, a lot of real assets, and equity should provide some kind of benefit too. And then we really pulled back on our fixed income. I mean, we pulled investment grade out altogether because we just weren't getting paid for it. And then 5 years ago, maybe more, we pulled out of all our global core investment grade bonds. Because I mean, do the math. I mean, they're paying negative real yields. Why would you invest there? So I think, you know, because you can't catch up in deflation. You know, when inflation happens, it's kind of too late. And we have, and we've got a lot of commodities. We years ago started investing in precious metal through miners because we thought, I kind of wanted to buy gold, but the team wouldn't let me because I just look at the gold on the table. But yeah, so I think from an inflation protection standpoint, we're about as good as we can be.
So I got one question that I think most people don't have a grasp of. Your team and you guys, your whole team gets together and thinks about your pension fund liquidity and getting money back out of. You talked about some assets, miners, farms in Australia, farms in Peru. A little less liquid. So how does your whole team think about across the portfolio and the cash coming back in and the need for that, for some of that to be liquid and some of it not as worried about?
Yeah, that's an area that I care deeply about. I was told my first day on the job that there's only one pension emergency, and that's telling the CEO that you can't send out the pension checks. So, and it matters. And so, in the global financial crisis, that's it really scarred a generation of investors. And you got to be careful of that. But you learn that what you thought was liquid wasn't. You couldn't get bid out of bonds. I mean, I had a bunch of, over $1 billion in Core Plus that was, down 25%. Now, in retrospect, that would have been a good trade, right? But so we build internal models, frankly, just simply to stress test the portfolio. So if we're down 10%, 20%, 40%, can I make my pension obligations? Can I rebalance the portfolio, right? Can I take advantage of that? And can I then deploy private capital for opportunistic investing? So we do that periodically, and we've had many kind of shocks to the market, and we were okay. And in the pandemic, we were able to turn $2.4 billion in like a week. Rebalance the portfolio. So at the very bottom, our timing was, we were, the way we were structured, okay, you have a shock, it's time to invest money. This is the qualitative part. Normally we rebalance on the quarter. The team was just going back and forth, and I'm like, we gotta move right now. And because we've been so close, we were able to kind of coalesce around and say, okay, it's the right thing to do. So, and because we had been very thoughtful in deploying our assets, we were able to find liquidity when other people couldn't. We've moved a lot to institutional ETFs, which turned out to be just brilliant because they were liquid, but that comes from having a team that thinks about liquidity. It matters. And and it's one last thing, that one of the things that came out of the global financial crisis is banks kind of got out of the business, providing liquidity. So hedge funds in a weird way took over. So private capital became a source of liquidity now. So we knew that when the markets kind of sold off, that the normal suspects weren't going to be there on the other side. So in knowing that, it kind of told you that our fixed income needed to be treasuries, needed to be really, 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 really liquid. Because stretching in that area just wasn't worth it. So it had been top of mind and topic, but the intention is to make sure that you don't shy away from taking risk. You just take risk in the right budgets. And then we have discussions too that, you know, when we make an investment, even if it's like semi-liquid, that it's semi-liquid, you know. So you just like don't. If they tell you you're going to get it back, you're not going to get it back in a crisis. It's not good.
That's
Yeah.
the secret of this, right?
Yes,
I'll
yeah.
give it back as long as we're not way down and it's
Well, they'll give it to you if you don't need it.
Yeah.
You know, that's and that matters.
So why don't we wrap up with a couple questions before we get to rapid fire around a topic near and dear to our heart, which is first-time funds.
First-time funds.
First-time funds.
Do you?
Let's make this super authentic. Let's sleep time capital. You know, how would you look at Doug and Derek and say no quickly?
So and I think part of the interesting thing there is you know, it's always that challenge of going 0 to 1. 1 to N is usually easier, but going 0 to 1 is challenging. What's your advice for first-time funds, first-time fund managers? That could be in the PE side, VC side.
Yeah. So
I'm taking really good notes too. As
you are taking good notes. Yeah. Yeah. So this isn't awkward at all. But the way we are a little bit different. So a lot of institutional investors, you know, they won't talk to you until Fund 3. So they may have a consultant, right? Or they just may be like, we're going to let you make your mistakes, and then we'll. Some people didn't have rules; they just won't do it. We will invest with newer funds, and part of the reason for that is what we've seen on the private side is it's that fund, you know, up through 5. You know, you're hungry, you're doing well. Then things start to change. You know, it's like. So we're looking for people who are energized, they're hungry, they're going to work extra hard because they're building wealth. You know, when you got a couple $1 billion under management, or let's say you got $50 billion under management, or $100 billion, or $500 billion. Well, now all you care about is your fees because you get rich on that. We want somebody where that carry matters. So, so that's where someone like you would be attractive. You know. And we would look at that. Then on the other side, sometimes what you're waiting for, and this is where it's like when you're looking for a job. Well, how do you get experience? Well, I haven't done it. I'm doing it right now. It's like, you know. So what I would look for is, like we talked a little bit before, that I think you guys are a good team. You know, you have complementary styles. And this is kind of stuff we talk about because at the end of the day, I'm investing with people, right? So I want to make sure that I see a team which has, you know, when you're talking about that functional tension. So you got complementary skill sets. So that's something I'm going to look at. And then we're going to look at, you know, what's your niche. So we like smaller funds, you know, because everything's gotten so big. Because we think they got a better chance to succeed. So that's something that we're going to look at. And then we look, if we're going to seed somebody on the smaller side, we're looking for co-investment opportunities. So do you have the ability to source that? We're also, because we're looking for someone that can expand our network. So what's the value add that you can provide to me?
Yeah.
You know, maybe it's co-investments, that's great. You know, no fee, no carry, obviously, you're not going to get a promote because that would be wrong and evil. But can you lead us to other people? You know, are you interesting? You know, do you view the world in a slightly different way than I do, or my team members do, and that we can have kind of engaging conversations. So those are the kind of things we look at. But the thing is, like, you know, it goes back to you too. Why should I give you money? Why are you special? And that's we're looking for something that we can almost put a hook on. You know, we're like, because you listen to a lot of pitches, but suddenly you're like, you know, I like those guys or girls. Okay, but I like their approach. And we've talked a lot about. So you got the West Coast, Silicon Valley, and you got the East Coast, right? We've talked that everything's really expensive. Well, they're really expensive, you know. So we've thought that if you're around universities in the Midwest, this is where, you know, Ed Michael, who works for me, I just gave him a plug. But we talked a lot about the idea of looking around research universities, because there's a lot of technology transfer. Universities have, you know, I mean, you know this. You know, there's a lot of development, you know, business development, you know, IT, things like that, and it's not priced as high, you know. So, and there are people too. It's like we're in the Midwest. It's like if travel far, you can
They're good Midwesterners.
good as opposed to because some people are bad who are if they're not from the Midwest.
It's true. It's
Well,
true.
now they can be good if they want to be. Although no, that's not true. We get a bunch of people are moving here.
To the Midwest,
Yeah,
are they? They should stay away. So one last question before we go rapid fire, kind of based on this first time fund concept. How important is it to you to be a contrarian as you think about investing? If you want to provide something above and beyond the market average return, you have to kind of have to be a little bit something special, something different. How do you think about and so a first-time fund kind of maybe has some of those qualities, which is it's untested, but there might be some kind of novel hook. How do you think about being and kind of promoting a contrarian, diverse view onto investments?
I think having I talked about you look at themes. So have you identified a theme that I think the market or the trends in the world are going to support? Have you identified an investment area? So seeding local businesses, right? Seeding CEOs to start businesses, to buy businesses, right? So you're identifying the talent. Now, you've got globalism, the move towards people reshoring businesses here. You think about COVID and people moving all over the country now. There's a supportive tailwind to that. You're gonna see industrial production probably at a higher level come back to the U.S. It's going to. We don't. Countries and businesses are not gonna want to be left to chance anymore. That just-in-time delivery sounds super awesome until just-in-time means like a year from now.
More resiliency in the supply chain.
Yeah, but I think the other danger, now I'm going to share a little bit of myself and my team, is you got to be careful about the danger of just being too smart, too clever. And I think I've made that mistake before. It's like I like an idea because it's just so interesting and it's complex, it's innovative, and it's like innovate. There's a lot of innovative companies that aren't here anymore.
I'm just your water, Jeb.
Yeah.
You're making me choke up. This is so good.
So, and I don't like to admit that. That sometimes you can be too smart, you can be too clever, and at the end of the day, it isn't that common. Do you think this idea can make money? Do the risks? Are you being compensated enough for them? And just because you think it's a good idea, that's where I look for those tailwinds. Is the rest of the world going to embrace it? Because at the end of the day, whatever investment you make, it's about selling something. Does somebody want to buy it? Does somebody have to buy it? I think that's the other area that we look at is we want to put our money to work where people need our money.
Yeah.
That's
What do you think? One of my favorite Peter Thiel quotes that he has, which is a question he asked in his interview, which is like, tell me something you think is true that everyone tells you is actually wrong, that everyone thinks, do you have one of those things offhand, Jeb?
Oh my God, that's great.
Is that too hard?
You should have talked to me beforehand.
Okay,
There's no chance I'm going
Alright,
to. Now we can talk about branding. The important. People have told me that branding doesn't matter, and I know that my personal brand, the brand of my organization, the brand of my university, these things matter.
Yeah.
And they resonate with people. That's the other thing, is because people get to know you.
Yeah. You got that great Ghost Bronco.
Yeah, you like this?
I do.
Yeah, it's a little bit old school, but love the Broncos.
That's right.
And Buster was there for me back in the day. Shared the love.
Maybe you'll be back.
Have you seen Buster? Do we know where Buster is?
Yeah. That's a topic for a whole other episode.
Don't know where he is.
Yeah.
Or she.
Yeah. So let's go. We're gonna go rapid fire to wrap things up. You ready to go?
Rapid fire.
Rapid fire.
Quick, short.
One word, two word. Don't give me any explanation. Can you do that? And that might be difficult.
No, I could totally do that.
Okay. Here we go.
Sure.
Here we go. This is gonna be unedited.
Wait,
so-
hold it. Yes, no. Is there can it maybe?
No.
So just yes and no.
Correct.
Yeah.
Can I phone a friend?
One word.
All right, okay.
Favorite leader?
Teddy Roosevelt.
Courage or compassion?
Courage.
Speed or accuracy?
Speed.
Great ideas or great execution?
Great execution.
I was kind of expecting a little something different from you, but that's okay.
Well, I'll just tell you that I just kind of like, on that one, I was like,
It was a big, you didn't just, it was like a big huff there, like.
Yeah.
I wanted to say great ideas, but at the end of the day, getting it done right is what matters.
Yep. Okay. A word to describe your leadership style.
Visionary.
Are you a night owl or an early bird?
Naturally or in practice?
Just kind of naturally, I guess.
I know.
I know. Okay.
In practice.
Early.
Okay. You're heading into a dangerous jungle. It's very difficult business task. You're about ready to go in and face this dangerous jungle. Who do you bring with you?
My guns.
Okay. And then if you had an animal, Jeb, that really represented your leadership, what would it be?
Oh, the raven.
Yeah.
The raven.
Why the raven?
Well, it's my spirit totem animal, and that's another segment. We'll get into why that is. If you think about it, ravens are smart, they're survivors, and they're loyal. Pair bond for life.
Ravens are smart. Ravens are loyal.
They're loyal?
To their mate.
Okay.
And what was the third
They're
one?
survivors.
They're survivors. Ravens are survivors. They also fly. I guess that would be nice to have.
Yeah.
Jeb Burns, glad we could do this. Thanks for joining us on The Jungle.
The Jungle is my favorite podcast.
Thank you.
Thank you so much. This
Cheers.
is great.
Cheers.
Cheers. Thank you, Jeb.